Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report that's a bit like a financial escape room, filled with hidden clues and tricky turns. We will discuss why even in the world of finance, the dates can be tricky. But before we get started, if you're tired of financial jargon and want the real story behind the numbers, make sure you're subscribed to catch all our deep dives. Also, join our Discord server down in the description to connect with fellow financial sleuths and get even more insights. If that's something that interests you, that's something for you to gain by being part of the community. We're looking at the annual shareholder report for the Multi-Manager Directional Alternative Strategies Fund from Columbia Funds Series Trust I. This isn't your typical stock. It's a fund that uses a mix of strategies to try and make money, regardless of whether the market is going up or down. Let's decode what happened between May of 2025. First up, let's talk about costs. Imagine you invested $10,000 in this fund. The institutional class would have cost you $252 in expenses, which is about 2.37% of your investment. It is important to know that when a portion of your hypothetical $10,000 is not returned and instead is kept by the company as an expense. Now, who were the MVPs and who fumbled the ball? Turns out picking the right stocks and allocating investments wisely in interactive media, pharmaceuticals, and semiconductors really boosted the fund's performance. Some standouts included Reddit, Verona Pharma, and Astera Labs. Looks to be their long position, a bet that the company will do well and the value will go up. Really paid off. On the flip side, stock selections in software and healthcare equipment didn't do so well. Allocating too much to energy equipment and not enough to hotels and IT services also hurt performance. Eli Lilly, Silicon Motion, and Atlassian were among the top holdings that dragged down returns, all long positions as well. The company might want to take a look at investing in the opposite companies of the ones it is right now. Could be a successful strategy given the apparent ability to pick the worst bets. So how did the fund actually perform? The institutional class had a one-year return of 12.89%, not bad, beating both the HFRX Equity Hedge Index and the Wilshire Liquid Alternative Equity Hedge Index, but trailing behind the MSCI World Index and the S&P 500. Over 5 years, it averaged 10.26%. Since the fund's inception, it's averaged 5.43%. Important disclaimer that the fund's performance prior to late February of 2025 is from different financial advisories. Let's glance at some key stats. The fund has about 264 times $6 million in net assets and holds a whopping 602 different investments. Plus, the portfolio turnover is 344%. The 344% means the fund is not simply buying and holding to ensure a stable portfolio. The money is actively being transferred and is not sitting still. Now, for a bit of corporate musical chairs, the fund had some changes during the year. Summit Partners took over management of one part of the portfolio in July. Also, Allspring Global Investments is no longer a sub-advisor. Change is part of life, but in investing world, it is concerning. There's a lot of technical description of policies and fees, but what it comes down to is that the audit the audit committee has to pre-approve the fees for the financial reports, which is honestly a good thing. They have to have controls and be transparent about all of the expenses and actions. This is where we can actually see how much the audit fees were. In 2025, the audit fees were about $52,732 and the tax fees were $16,420. The non-audit fees billed to the investment advisor were $474,000. Let's break down how those millions of dollars are being spent. Take a look at communications, with Spotify and Walt Disney each having a noticeable chunk. There's also positions on telecom companies and wireless telecommunication services, but they are negligibly small and should be grown. Then you have consumer discretionary sector, household durables, hotels and restaurants, and specialty retail. Moving on, we have consumer staples. Beverages, including Coca-Cola is big one, food products, personal care products, and tobacco. As for energy, the company is mostly investing in oil, gas, and consumable fuels. In the financial sector, they are betting on banks and capital markets, intercontinental exchange, consumer finance, financial companies like Berkshire Hathaway and Visa, and insurance from Allstate to Progressive. The financial sector seems to be pretty balanced on what's working and what's not. Healthcare is focused on biotechnology, healthcare equipment, and healthcare technology. For industrials, it is aerospace, defense, air freight, and logistics, building products, ground transportation, and professional services. Lastly, technology investments are allocated in semiconductors and semiconductor equipment and software. If you look at all of these combined, the report shows Colombia has some key strong positions, but also is potentially going all over the place without the ability to commit to any fund-specific segment. One thing also to note is the common stocks numbers sold short came out to about negative 84 million. So this begs the question of, can you get any returns with this kind of mixed strategy? Exchange traded equity funds, Colombia seems to be mostly betting on iShares. Looking at the specific values they have in each warrant, almost all of them round to zero, seems a bit odd. And a lot of costs also come from put and call options purchased. This fund truly implements a ton of financial instruments, which might be concerning for some people because things can get overly complex. A large percentage is dedicated to money market fund, which sounds like a low risk investment, but comes at the cost of low rewards. The other part of the portfolio comes from securities sold short on communication services. Some big holdings include Liberty Global, Lumen Technology, and TELUS. Consumer discretionary short holdings have stocks like Fox Factory Holding. When looking at consumer staple short selling stocks, they include Bicol SAB and Boston Beer Co. So there are a lot of short sell choices, including banks, capital markets, consumer finance. In healthcare, the short-selling stocks include Anavex Life Sciences Corp, RRS Pharmaceuticals. As for industrials, they seem to have a lot of ground transportation stocks and airline stocks. The fund tends to short hold the more stable sectors like the electric grid and food sectors, and long hold tech and healthcare ventures that might grow bigly. And finally, regarding information technologies, Arista Network. There are a few material stocks too. The reason these sales occur is to offset an overinvestment in one area with selling to a different company with opposite performance. Overall, this is a high risk, high rewards play. You can gain big or lose big. Some of core option contracts purchased have stocks on Dr. Ing H. Tassaf Porsche. They make a large number of individual purchases in this category, indicating some interest into the luxury automobile sector. It begs the question of where is Ferrari and why a smaller Porsche stock when the fund is supposed to have big and bold choices. Average value of swap contracts are relatively low, but what's most important is whether their swap strategy is actually helping them in profit or not. Before we wrap up, it is important to keep in mind tax implications with each investment decision. Qualified dividends range to a relatively small number. Excellent, now let's give our opinions. Okay, wrapping this up. So what's the verdict with this fund side? The returns on the fund and its derivative are pretty impressive right now. A lot of them beat any fixed interest savings account and almost all of the managed sectors. We see good decisions on which stocks to pick and hold. However, it is concerning all of the changes this fund is undergoing with changing managers. If is a ship that does not chart a clear direction, is it really a ship? This fund lacks a clear signal of what it truly is supposed to be and needs a bit of refining. Also concerning is the risk of everything going to nil. While on its surface they might be doing well, a lot of downside is related to high reward assets and high risk assets, meaning this ship, if it crashes, it will crash hard. So final verdict, unless you have iron hands and nerves of steel, as well as a deep understanding of how the market work, avoid this fund. And what do you think of this fund? What would you rate this? Let us know in the comments below. Remember to like and subscribe for more corporate deep dives. Also, the Discord community link is in the description if you want to discuss more or ask your own questions. See you next time.